Imagine looking at the final score of a football match. You can see clearly who won at the final whistle, but you have no idea how the game actually unfolded. A standard line chart in trading works exactly the same way. When you only look at the final closing price for the day, you miss the context. You can see where the price ended, but you can't see the momentum swings, who took an early lead, or the moments where the market nearly broke. This tool shows exactly how a financial asset moved over a specific period. It is called a candlestick chart. Instead of a flat summary, a candlestick is the match highlight reel. It captures the entire story of the battle between buyers and sellers. These shapes allow you to zoom in on the specific moments where traders made their moves, showing you exactly how much territory was gained or lost during the session. While a line chart shows you the path, it doesn't show you the resistance. If you want to really anticipate what happens next, you need to see the struggle behind the price. The first rule of reading these charts is simple. Every single candlestick you see represents one fixed block of time. That could be 1 minute, or maybe 1 hour, or an entire day of trading. This timeline records exactly 4 data points for that specific block of time. Traders call this OHLC: open, high, low, and close. The open is the very first price traded when the clock started. The high and low represent the absolute peak and absolute rock bottom prices reached, and the close is the final price recorded when the time period ends. These 4 points take a chaotic flurry of thousands of trades and organize them into a clean, readable map of exactly what happened. On this diagram, the distance between the opening and closing price creates the thick central section of the candlestick. We call this the body. If the close is higher than the open, the body turns green. Buyers were in control, pushed the price higher, and held that territory. If the close fell below the open, the body turns red. This means sellers dominated that block of time and drove the value down. The physical size of this rectangle measures the market's conviction. A massive, tall body shows total confidence and a decisive victory. A thin, flat body shows a stalemate where neither side could gain ground. With a quick glance at the body, you instantly know who won the core battle while the clock was ticking. You will also notice thin lines extending from the top and bottom of the main body. These are called the wicks. The upper wick shows how high buyers pushed the price before sellers swatted it back down. It represents an aggressive rejection of high prices. The lower wick reveals how far sellers drove the price down before buyers stepped in, bought cheaply, and pushed the value back up. The solid body shows you the logical, final result of the session. But the wicks reveal the hidden emotional extremes, the fear and greed that happened along the way. Once you understand the anatomy of a candlestick, you can start recognizing specific shapes. These shapes act as an early warning system for where the market might go next. This is a classic pattern called the hammer. You can spot it by its short body at the top and its massive lower wick, often appearing after a large drop in price. When you see a hammer, you are looking at a total rejection of low prices. It means sellers tried to drive the market down, but buyers forcefully reversed that momentum before the session ended. Another common shape is the doji. This chart shows a candlestick resembling a cross, where the body is virtually non-existent because the price started and ended in the exact same spot. The doji represents total market uncertainty. It is a snapshot of a complete stalemate between buyers and sellers, where neither side could hold their ground. Recognizing these patterns transforms a chart from a chaotic math problem into a predictable map of human behavior. Many popular trading tools rely on what we call lagging data. They look at what happened in the past and react slowly to market changes. Candlesticks provide immediate, real-time feedback on who is winning the market right now. This is the starting point for reading the market purely by its own movement, rather than waiting for a delayed calculation. Just remember, a candlestick tells you exactly what is happening with the price, but it doesn't explain why. That is why it's important to combine these shapes with other tools. If you're just starting out, try practicing in a risk-free environment, like a simulated demo account, before ever using real capital. Learning to read the highlight reel of wicks and bodies is the first major step in replacing guesswork with a clear, informed strategy.